So our 4 battle categories are cost, exposure, strategy, performance, and then our mystery category. For mystery, that's where you, our judges, can choose a certain factor or thing that you feel is critical to today's contest. Our judges can also nominate wildcard ETFs or opt for split decision. It's up to them. I've got the scorekeeping chores, and at the end of the show, we will announce an overall winner. Keep in mind, none of the battle outcomes are ever predetermined or known in advance by myself or our judges. So let's kick things off with Shayna. Sisters before misters. The first category is cost. Shayna, please get us started.
Sure. So this is a really interesting one. Neither one of these ETFs are particularly expensive. SPLV at 25 basis points, USMV at 15 basis points. They're both sizable funds at 10 billion and 28 billion respectively. They trade, they're very liquid. They don't have a lot of spread in their trading. So it really just, at this point, it has to come down just to the numbers.
Also think will happen is the thing that's going to help stop the Fed from continuing to raise rates is going to be a huge decline in corporate earnings. And so our guess is that the earnings estimates for the fourth quarter and for early next year haven't come down enough. And what we're going to get is one of two things, either more rate hikes or huge decreases in earnings estimates. I think the beginning of this week, people were relieved about pretty good earnings, but the other side of that means more rate hikes.
So you've been advocating a slowdown or reversal in earnings growth for several weeks and months now. Is this starting to pan out the way you see?
Yeah, it sure looks like it. We're looking at a chart that FactSet published, just looking at sector revisions. And, the street came into the year looking for something north of 10% earnings growth this year and next. If we look back to just the end of the third quarter, those expectations were reduced to about 8% earnings growth. But 2 weeks after the end of the quarter, we've now seen revisions come down to something with a 6 handle for growth this year. And honestly, I think at the rate of change that we're seeing earnings revised to the downside, we're very likely to get to our minus 5% year over year earnings growth for calendar 2022 in the weeks ahead, to put it that way. If you removed energy from this, earnings growth this year is down 4%. For the 10 sectors in the S&P X energy, basically.
But they are making the steps to turn themselves into a proper like media company, like of massive size. So, but to get back onto that advertising side, I think they're going to attract more viewers from it. To your point, you will see some people drop down and prepare to do it. But you're going to have the ease of option, be like, you know what, next month I'm going to pump myself back up to full for a few months and do those sorts of things. So I think they're going to bring some audience back in. It's, to your point, on the advertising side, it can get annoying, but younger generation like to see ads. They don't want to like seeing the consistent AT&T and all those different ads all the time. But I think you'll see some more companies start putting their content in for those ads because they're going to get bang for their buck.
I will say it's been some trying times being a wealth manager recently. These volatile markets have certainly been testing advisors and the investment community as a whole. What advice are you giving to clients at the moment?
This is my favorite question of all times, and I've only answered it about 1,800 times in my career, and a lot in the last couple of weeks. And the surprising answer from me is nothing. And that doesn't mean do nothing. It just means that if you haven't done planning for things like this, if you just assumed everything was going to be rosy or everything was going to be horrible, which a lot of people assume right now, somebody, whoever your advisor is, has not been doing you justice.